with the end of the war, Sri Lanka now has probably the best set of circumstances it has ever had over at least the last 50 years. Not just the 30 years of the conflict, but going back to the late 50s. Because from the late 50s, there were a number of major drags that constrained the development prospects of the country. First, you had a secular decline in the terms of trade. Starting from the late 50s for about 25 years, at that time Sri Lanka was a tea, rubber, coconut economy, and the prices of those key commodities declined on a secular basis for 25 years. So that was a major drag on the development prospects of the country. At the same time, there was a surge in the population. There was a demographic surge. So you had a situation where the surpluses in the economy was coming down and the population was increased. The twin effects were constraining the development prospects of the country through the 60s, 70s. Then there was on top of that, we had inward-looking dirigist policies, which were now, actually with the benefit of hindsight, such policies are not considered appropriate for any economy. Even China, India, etc. have now opened up to the world markets. But at that time, the consensus was that developing countries should seek to insulate themselves from the vagaries of the world market and pursue inward-looking policies. And Sri Lanka was part of a group of countries which pursued these inward-looking import substitution type policies, which were wholly inappropriate. And they led to economic stagnation, and by the late 70s, we were a low-growth, low-investment, high unemployment economy. Then there was the liberalization of the economy, but the country was not able to reap the full benefits, partly because the liberalization process was partial, but more than that, you had the onset of the conflict. So another big drag on the development prospects of the country. At this present time, there are no such drags, like the terms of trade decline, like inward-looking policies, like the demographic surge. But on top of that, not only are there no constraints, major constraints on the development prospects of the country, but economic geography is very favorable. Sri Lanka has two major assets. One is excellent political relations with China, and the second is proximity to India. We need to basically leverage on these two assets for the benefit of the development of the country. So how does one do that? There are three things which are crucial. One is we need to create stable and business-friendly macroeconomic conditions. From the liberalization of the economy in 1977, the major source of instability in the economy has been the budget deficit. The unsustainable budget deficit has consistently pumped excess demand into the system. That has meant that inflation has tended to be high. When you have high inflation, interest rates have to be high. Nominal interest rates are high. When you have high inflation and you have an inflation differential between yourselves and your competitors and trading partner countries, then the exchange rate comes under pressure. But Sri Lanka had difficulty in maintaining a competitive exchange rate because there was a very high import component in the basic consumption bundle. Oil, wheat, milk products, pharmaceutical, etc. These are crucial everyday items, the prices of which increase if you depreciate the currency. To compensate for this inflation differential, i.e. the speed at which the costs were going up in our economy vis-a-vis our competitors, was such that we needed to adjust the exchange rate to maintain competitiveness, but that was politically difficult because of the impact on the cost of living. So we tended to have a overvalued exchange rate. So if one is to characterize the Sri Lankan economy over the last 35-40 years, it's been a high budget deficit, high inflation, high nominal interest rate, overvalued exchange rate economy. That is 180% diametrically the opposite of what the successful countries of East and Southeast Asia have done. They had very low budget deficits, low inflation, low interest rates, and undervalued and stable exchange rates. Just the opposite of what we've had, which is what explains their success and our relative poor performance, which is why we've fallen behind these countries. As late as the 1960s, Sri Lanka was ahead of both Korea and Singapore. But we've fallen well behind not only those two countries but several other countries in East and Southeast Asia, partly to a significant extent because we got this macro framework wrong. And the basic foundation of the economy was on a non-competitive basis in terms of high interest rates and an overvalued exchange rate. Okay, so the first thing that we need to do in terms of taking advantage of this opportunity that I talked about at the beginning is to get the macroeconomic conditions right. First thing is getting the budget deficit right. And there are some positive signs. The deficit, which was 9.9% in 2009, the recorded deficit was 5.8% in 2013. There were some arrears, which is not reflected in the deficit, but even if one takes that into account, the direction of travel is certainly positive. So the first thing the government needs to do is to maintain its commitment to fiscal consolidation and to continue on the trajectory of fiscal consolidation that it has set out for itself. If one does that, then one can create the conditions for having stable and competitive macroeconomic conditions, i.e. to have low interest rates and a competitive and stable exchange rate. So that's the first thing we need to do. The second thing we need to do is to take advantage of these two assets that I spoke to you about, which is, one is this India proximity, China, excellent relations. That's the second. And think of a scenario whereby we are able to attract, and as you know, we already have a free trade agreement with India, and we are about to complete another free trade agreement with China, which means Sri Lanka now has preferential access to a market of 2.5 billion people. So how do we take advantage of that? That is a potential game changer if we are able to successfully take advantage of that opportunity. So one possible scenario is whereby you get foreign investment from China into Sri Lanka to create competitive supplies that can be sold to India using the Indo-Lanka Free Trade Agreement, and also to sell some material and services back to China. Similarly, one can get investment from India to create capacity to export to China and to sell back to India. So that kind of framework, using the two free trade agreements to generate competitive supplies, which Sri Lanka can sell to these two very large markets, is clearly something, if we are able to realize the potential of such a situation, it will definitely be a game changer. And the prospects of achieving that have been improved by the government's commercial hub legislation, which is being proposed. If it comes into place, one would have these free ports and bonded areas, which can create enclaves for the FDI to come in and create these competitive supplies. If necessary, we should have industrial zones for Chinese and Indian investment and other investment if necessary. Because what we really need to do is to create FDI-driven export. Our basic growth model needs to be based on FDI-driven exports. The current model, based on remittances and commercial borrowing, is not sustainable. Because if we send more and more people out of the country, particularly more skilled and semi-skilled people, as we seem to be trying to do now, we will not have people to develop the domestic economy. Equally, we are now reaching the upper threshold in terms of commercial borrowing, If you look not just at the debt to GDP ratio, one needs to look at debt servicing as well. Debt servicing is getting close to 20% or is 20%, which is really the amber light territory, so we need to be cautious going forward. So we need to move from a remittance stroke foreign commercial borrowing funded growth model to an FDI and exports funded growth model. So that's the second thing we need to do. And a more stable macroeconomic condition, plus taking advantage of these assets that we have in terms of India, relationship with India and China. If we are able to take advantage of that, then we will be on a different growth trajectory. The third important thing we need to realize the potential of this situation is human resource development. We need the people to create the new growth sectors, whether it's maritime, whether it's aviation, whether it's industrial zones producing for the Indian and Chinese markets. For all that, we need human resources, and we need to align our education, training and skills development to the dynamic comparative advantage of the country. The sectors which are going to be the future growth sectors, need to make sure that we train enough people to be able to support growth in the sectors where we have a dynamic comparative advantage. Really, this, in terms of achieving a much higher trajectory of growth, I have given one scenario which is really discretionary measures which take advantage of the proximity to India and the excellent relations with China. That is clearly a potential game changer, but there are also other measures that need to be taken to improve the overall business environment. Because that model that I spoke about of these, the two FTAs and supported by the commercial hub legislation is biased towards FDI and FDI-driven exports. But one also needs to improve the domestic economy to make that more competitive, so that domestic investors, and by domestic investors we are talking from the small agriculturists, people running small shops, through to the domestic corporates, we need to create a more competitive environment for them as well, so that we have more balanced growth, we have more inclusive growth. And there again, there are a number of things that we need to do. I have mentioned already that we are on the right track so far in terms of the stabilization of the macroeconomic conditions. There is more work to do, and we need to maintain discipline. In the past, we have not always been able to sustain discipline, so it's important that we sustain discipline. But we also need some structural reforms to improve the productivity of the economy. Because without higher productivity, you cannot be competitive. Without higher productivity, you cannot have non-inflationary sustained growth in output, incomes and employment. So the key thing is improvement of productivity. How do we use our factors of production more efficiently? And if you look at the factor markets, whether it's the land market or the labor market or the capital market, there are a number of reforms that are possible. There are a number of reforms that have been actually on our agenda for many years, which we have not been able to implement. For instance, creating a pre-cleared land bank. At the moment, it's impossible to get land for commercial activity. The government owns 80% of the land. Departments like railways and the postal department own prime real estate around the country, which can be released and value can be created from that. But we need a systematic way whereby land is pre-cleared for commercial activity. And also tightly. If one can give proper titles to people living in the urban areas or even in some of the rural areas, that creates an asset which can be used particularly by those in the lower income deciles of the income distribution to create value for themselves. So that's land. Labor again, our labor market is very inflexible. Our culture in Sri Lanka is such that one can never have hire and fire policies. However, there are ways in which the labor market can be made flexible. Because what is happening now is because we have such rigid labor market policies that even the large corporates in the formal sector circumvent these rigid policies by hiring people on a temporary or casual basis, which means that their labor standards are lower than they would be if they were part of the permanent labor force in a more flexible labor market. Similarly, people in the informal sector are reluctant to come into the formal sector, to register and come into the formal sector because of these very high costs which would be imposed on them through these rather inflexible labor market conditions that we have. So really we need to have a bit more flexibility in the labor market, in which case I think overall labor standards in the country would be improved because corporates will hire more people on a permanent basis. People in the informal sector will move into the formal sector and maintain higher labor standards. So in fact, the current very rigid labor market is an anti-labor market at the moment, and it can be made more labor friendly. Similarly, capital markets, work is being done. The stock exchange is being developed. The SEC and the CSE are working together. We need more work to improve the capital market. We also need, and this financial consolidation process by the central bank, I think makes sense. Countries like Malaysia, Singapore have all done this. Other countries are doing it. Really, we have too many banks. We have too many non-bank financial institutions. That makes the whole financial system more vulnerable because we have a long tail of rather weak financial institutions, particularly in the non-bank financial institution sector. So this tidying up that is being taken place, led by the central bank, is a positive thing, but it must be done. The due diligence must be done. It must be done in a transparent way, and we need to create fewer, more stable financial institutions. It will improve the stability of the financial system, and it will also make it easier for the central bank to regulate the financial sector if it has fewer, stronger financial institutions which have a higher capital base and a higher asset base. Also, on top of that, strengthening the financial sector is important, but we also need to develop other elements of the capital market like angel capitalists, venture capitalists, private equity. These are all institutions which fill different parts of the capital market, and they provide capital in different ways which enable the country to generate sufficient investment to sustain a higher growth rate, an 8% growth rate for 10, 15, 20 years. So each of the factor markets, whether it's land, labor or capital, there are areas for further development, and we need to press on with that. Plus, of course, one needs to look at the state-owned enterprises. The senior minister, Sarat Amanugama, spoke about how China reformed its state-owned enterprises. They made them more autonomous. They were much imposed a lot of discipline in the way they were operated, and I think there's plenty of work that needs to be done. Work has been done. They've been commercialized. More work needs to be done in that direction. The other thing in terms of competitiveness of the economy, and these are long-term issues, they can't be addressed overnight. For instance, in agriculture, 32% of the workforce is in agriculture, but it accounts for only 11% of GDP. Therefore, productivity in agriculture is 1/3 of the national average, and the national average is lower than countries in East and Southeast Asia. The other large well of low productivity is the public service. We have 1.3 million people. Some years ago, there was an exercise done about 10 years ago when the ideal size of the public service was thought to be 400,000. Even if one allows for the build-up in the armed forces that was necessary, we have more than double what probably one needs. So we have these two large wells of low productivity absorbing financial and human resources and giving the economy a very low yield. So we need to shift both people and money to higher productivity sectors. Now that is not something you can do overnight. It will take time. But we need to have a vision in our head of a more modern economy. If we want to support this 6 hub strategy, then we have to move people and money into those areas which have higher productivity. And that's not easy, politically difficult, but those are some of the things we need to do if we are serious about having 8% plus growth for 10-15 years. This whole opportunity in terms of using the leverage we have vis-a-vis China and India and moving towards an FDI-driven export model for the economy, an integral prerequisite for the success of that model is consistency and predictability of policies. Because really, if one is to identify a disappointment in the post-conflict scenario, it is the investment performance. Domestic and particularly foreign investment has not picked up in the way one would have expected since the end of the conflict. And an important reason for that is uncertainty and a lack of confidence. And the way to address that is to have greater consistency and predictability of policies. Now, if you look at the system, there is quite a lot of liquidity in the banking sector, but credit is not moving as much as one would expect. Equally, the corporate sector has quite a lot of cash, but it is not investing. So one needs to ask the question, why is it that banks are not lending for economic activity and not lending to industry and enterprises? Why is it that companies are not investing? And the only answer one can come to is confidence. And an important determinant of confidence is a predictable and consistent policy environment. And there we can do better. There is quite a lot of room for improvement. And if we get that right, then with the China-India factor and the commercial hub legislation, all that really, and the macroeconomic stabilization, it all come together to really take the country to a different level. But consistency and predictability of policies is a very important prerequisite.